a good cold email goes so much further in terms of like laying the land and the groundwork for what that first conversation will be like. And it also means, especially for those companies and founders that are hard to break into, you have to put in the work. You actually have to have a good understanding of what they're doing for them to even think to open up the email when it's alongside 100 other people after they've raised an awesome round from top tier VCs and they're all over Crunchbase.
Welcome to Partner Path, a podcast that unpacks the venture capital and growth equity ecosystem from a junior perspective. Young entrepreneurs and investors have already had a massive impact on the industry, having started unicorns and launched billion-dollar funds. We discuss these success stories and more by sharing perspectives and advice from some of the industry's most prominent role models.
Today we have Dawit Heck. Originally from New York City, Dawit attended college at the University of Pennsylvania. After graduating in 2017, Dawit worked as an investment banker at Lazard. After spending 2 years at Lazard, Dawit joined Longridge as a growth equity investor. Since joining Bain as an associate in 2020, Dawit has been promoted to principal. Welcome, Da.
Laura, Will, thanks for having me, guys.
Let's start with takeaways from your first two jobs. What did your experience in investment banking and at Longridge teach you?
Yeah, so I'll even go back a little bit further where I interned at Bank of America for 2 summers, both sophomore and junior year in their financial sponsors group, which is effectively just working with all of the financial sponsors on helping them facilitate leverage buyouts. And I liked it, but I thought if I was going to go into investment banking, I wanted to be in as technical as a program as possible. And restructuring offered that. And at the time, and I think still today, Lazard is one of the best debtor restructuring practices on the street. And the difference between debtor and creditor is simply you have people who do restructuring, which is just helping companies that are not doing too well, that are in and out of court bankruptcy, insolvent, helping them basically restructure what their capital stack looks like. Typically, they have too much debt and not enough revenue or not enough cash to facilitate paying that off. And there's people who do a lot of creditor work, which is helping the people who are creditors, financing all the debt. And there's a lot of people who do debtor work, working directly with the companies. And I thought it'd be a great experience to work directly with some of the high-profile enterprise CFOs and CEOs as someone really young, helping them restructure their organization and thinking about 100-day, 250-day plans post-restructuring to the extent that they were solvent. So I ended up working at Lazard for 2 years. At the time in 2017 to 2019, it was probably the era of all the retail bankruptcies. So I worked on a bunch of different things, including deals like Sears, Toys R Us, Remington Arms, and a bunch of others. And frankly, what ended up happening is there's a lot of companies that were insolvent and actually didn't stay around, like Toys R Us. And a lot of companies like Sears are able to basically sell off a lot of assets. And then things like Remington, the arms company, that were able to actually fully restructure. I realized I did not want to be a credit hedge fund investor probably halfway through the job. And I wanted to work in something where I was a little bit more hands-on, especially as it came across to doing a lot of the 100-day plan work. And what I saw was, wow, the software solutions that these people are implementing, they're paying so much money for. There's a new inventory management system that Sears uses, they're paying multi-millions of dollars a year. How can something that's old, legacy, and clunky be able to charge so much? So I started just basically digging into a lot of things in retail tech and a lot of things just generally in application software, and realized that the parts of the job I liked most are still something that was pretty technical, but wanted to do something that actually facilitated me to understand more about the actual company and what they do versus just understanding what their debt structure looked like. So I started applying to all these growth equity jobs and venture jobs. I say that actually getting a job from Lazard restructuring to a growth role was nearly impossible at the time. No one believed or thought that I was capable of doing the job. They're like, why would you switch when you have a clear path to go work at a credit hedge fund? The honest answer was, I actually don't know. What I do know is it seems relatively interesting, but I haven't done the day-to-day. There was a lot of firms that actually kind of fit the mold I was looking for, which are all of the bootstrap growth equity firms where they're effectively investing in companies that have raised little to no capital, that are growing well, are quite capital efficient, and maybe are profitable or have a path towards profitability in our hold period. And firms like Longridge that did a bunch of business software and financial technology exactly fit that mold. So I was lucky enough to join them in 2019, where I started to get my foray into actually what it meant to evaluate a B2B software business and tech-enabled services businesses, where our style was a little more private equity in nature, slightly value investing, doing a lot of long diligence processes. And it was great to actually understand, like, I didn't know what a cohort was before I started the job. And I think I kind of have a general idea of what that is now. So I worked on a few deals there, 3 actually that were able to go through in the 12 months I was at Longridge. But I think what I was missing was the ability to work really closely with category defining companies with really transformational founders in really big markets. A lot of the growth equity models aren't looking to invest in companies. Potentially they are, but most of them, they don't need the multi-billion-dollar outcome. And I just wanted to work with people where I could learn from the founders and the people around me.
So I think that's a good transition into walking us through Bain. Talk us through the fund size, investment strategy, and how you are posed differentiation in the market.
We're on our 11th fund now. As you guys probably know, Bain is a part of broader Bain Capital, which is a super large asset manager. Nearly 30 years ago, or maybe more, they spun out of Bain & Co., the consulting arm, to start their own private equity practice, of which there's now 9 business units, ranging from credit, public equities, real estate, private equity, our life sciences group, our tech ops group, which is basically right in between venture and private equity, and then there's us. And we're actually one of the longer withstanding business units inside of it. So we've been around for over 20 years now. Our most recent fund that we just raised that we're just starting to deploy actually in the past couple of months is $2 billion. And the goal is really to deploy, say, 50% of the dollars in early stage seed and Series A, and then 50% of the dollars into growth stage investments in those same respective categories. Obviously, the number of investments will vary. We'll probably do around 75 in early stage, but the core verticals that we spend time in are quite similar. So we categorize into 4 areas. We do a lot of fintech, a lot of infrastructure and security investing, application software broadly. So that's a bunch of vertical SaaS and productivity and collaboration tools and horizontal stuff, and then a bunch of commerce. Almost everything is B2B software. Our fund is about a little over 20 investors now, split half between New York and San Francisco. And the goal is pretty simple. It's let's just meet the most outstanding people as early as we can and be able to help them throughout the multiple courses of their company life cycle to be as strong as we can as an investor. And I feel like where we've definitely differentiated is not so much that being any different from the other multi-stage funds that everyone knows of, but really just having Bain Capital's network in our back pocket. So we're pretty much with the 900 portfolio companies across all of Bain Capital, we pretty much have access to every Fortune 1000 company that we can make introductions to and really facilitate go-to-market efficiency. There's that, and now that we have a really big fund, we've been able to hire a bunch of people on our platform team to help us with customer development, new hires across executives, go-to-market, engineering, as well as a bunch of people internally around data science to basically help us do a better job of sourcing new quality opportunities that we can invest in. In terms of how it's really split, Bain Capital has the private equity roots of being quite hierarchical. We've taken a little bit more of a flat approach. So while people have roles, the associate, VP principal, partner, managing director, we try to be a single unit, both across early and growth. And as an associate, it's an apprenticeship model. So you actually get paired with one of the senior partners. I work closely with Scott Friend, who's led all things application software and commerce for us out of the New York office for quite some time. He's been at the firm for 17 years. Previously founded a data analytics company that he sold to Oracle, and Bain was his biggest investor. And he had a bunch of people on his cap table, Battery Ventures, GC, JP Morgan Chase's venture fund. But he came back to Bain because he realized of all the people who opened the most doors for him as a founder, it was Bain. And he was selling into retail at the time, and he's had a bunch of people in their portfolio that could work. So I've had the good fortune of doing that. And now as a principal, have the opportunity to basically work with as many different people as I can, but still focused on this areas where I've developed domain expertise in commerce and application software and AI, as we feel that trying to have domain expertise, at least for us as a fund, is the most effective way to being able to run after things really fast, find really interesting people, and also triage it well.
And you mentioned Scott was a former operator. So I'm curious your opinion. I mean, how important do you think it is to have operating experience to, one, be a good investor, or two, add value add to your companies?
I think it really depends on stage. I find that on the 0 to 1, people, so that's really pre-seed and seed, people who have been operators have the best ability to actually make the biggest difference in terms of actually understanding what happens day to day and that things break, and be able to make the right introduction or just do it themselves of building or helping them hire someone to respectively build what they can't do. What I do really think, though, is as you go into early growth and thereafter, it's also all about grit. The relationships that you form with people who are product managers, engineers, executives across every different field is the best way to just be a sponge for information and then utilize that and all of the learnings you have from so many different companies' experiences to be effective to your portfolio companies. That said, I think some founders have preferences for operators, and some people just have preferences for the people they really get along with. And a good approach is just trying to be very true to yourself, have a lot of humility, but also have a lot of candor and honesty with whomever you're working with so that you can have a good relationship for the 5-10 years that you're partnering together. And I think that's kind of our firm, which is a lot of ex-Bain people. So there's a lot of consultants. I don't think anyone else has done restructuring like me. And then a lot of our partners actually have all been operators and have actually founded and sold companies.
And so what have you learned most from your relationship with Scott, the partner you worked under?
I mean, Scott's great. I think Scott is an amazing investor, and he's definitely, in commerce especially, where he's had so much experience building, probably the best there is, and has invested in a lot of awesome companies ranging from the Miracles, Attentives, and Rent the Runways of the world very early on, either at seed or A. What I've learned both from him and from our whole partnership is that there's a lot of things that you may think go right, and you can have your own qualms about a business. But in reality, there's one thing that is the North Star, and that is awesome people to invest in. And the founder is the best decision you'll make. And looking for just high quality people for which you can just help them build or help them figure out the right opportunity to then go after, like they just figure it out. There's a big piece of being able to communicate very well to the rest of the people at your firm and also to the founders you're working with in a very concise, pragmatic, and detailed way without actually saying too many words. And Scott's the best at that. So learning from him on being able to be concise is a huge, huge characteristic I'm trying to get even better at now.
I would love to hear a little bit more about your approach to thesis building and broadly Bain's view and then also your view. Obviously, you focus on e-commerce enablement as well as application software, and those are two pretty broad buckets to play in. And so I do think to a certain degree, I'd imagine that you focus on certain subsectors within that, and they're often supported by theses. And so what do you focus on when you're looking to build a thesis in an area? And what do you look for to potentially say, hey, this isn't a thesis that or an area that we'd like to invest in?
What I'd say is I developed a lot of amazing domain knowledge from working with a great domain expert. So I got caught up to speed on commerce really fast. And there's multiple sub verticals within commerce. I think I've dug into all of them at this point, and we've invested in a bunch as well. And then in application software, it's broad. So what I really try to look for in everything I'm doing is something where I see secular or durable changes that are happening on the macro level that are going to enable a tremendous amount of tailwinds that are going to be lasting for at least 10 years. At which point, I think there's a real opportunity to build impressive companies that are a little bit easier to sell into a respective customer because the need is so high. In those instances, there's two ways to look at it. There's sometimes the microeconomic labor marketplace idea of just how consumers are acting. And simple example in a very cool area where there's been a lot of interesting companies in the identification and fraud management space built is we have more devices and we have more endpoints. And as a result of it, when we have 30 different hooks that we're connecting to, you're going to need something that actually does a better job of preventing fraud and preventing someone from hacking your computer, which is why the Oktas and CrowdStrikes of the world have crushed it so much. That's the bottoms up. The tops down, and I think what we've looked at is, I'll take this debt collection, for example, or things in AML and KYC, which is anti-money laundering and know your customer. In both, there were actual secular changes, laws that were happening that made people reenact the way that they were doing business. And when that happens, either people get fined a lot of money and they realize, oh shit, I have to change something. Or two, they try to augment their current processes with something that makes it much more efficient to get output and high quality output. we've seen a lot of really impressive companies built in both of those spaces. And I've spent a lot of time in those respective spaces too, just at my old job in here. And then the same thing in commerce. I mean, it's hard to miss these days, which is privacy is happening. And we're looking for ways to effectively give consumers like more access to their own data and less for the people who are trying to utilize it for their own benefit. And that is merchants, that is the big platforms, that is the Amazons and Ubers of the world. That's anyone who basically uses customer data to make a decision. And that's getting harder with the iOS changes in GDPR. So there's been a lot of ways that people are trying to augment to get better first-party data access or do a better job of being able to reach out to that respective customer without issues.
And a little bit more on the sourcing side, what has been your general sourcing strategy and what tips and tricks would you give to aspiring VC analysts?
If I had the answer, I wouldn't be sitting here. I'd be retired on a beach already in a few years. But honest answer is there's no one right answer. I think you have to do every single thing at once and always be second guessing your own strategy to try something new. Depending on the stage you're sourcing, I think there's a few routes. I think one of the most effective ones is utilizing awesome people in your own portfolio to meet other founders who they are friends with and have connections to. The other is to meet up the most awesome product managers or engineers who are spinning out of really impressive companies like Stripe and Ramp and others who are starting their next gen idea because they've gotten so much great learning from these awesome enterprises. And then the last is like, you just have to keep your ear to the ground. So talking to experts, customers of and buyers of products, earlier stage, downstream investors to learn what's interesting in their portfolio and also being helpful to them and thinking about market opportunity. Those all work. And you have to do all in tandem. For me, I've actually thought that I've actually tried to pull up every few weeks and think, wow, did I get something really out of what I just did? Is it immediate ROI or long-term ROI? Right now, there's fewer companies raising just given the market. So it's a lot of long-term ROI building, and it's frustrating. And sometimes it's great, but you look up and you're like, I actually didn't get anything done that was producing real-time output for my firm and my colleagues today or this week. And that's hard. So I'm always trying to augment that with learning about a new market or speaking to buyers of respective tools, just get a better feel for what's interesting. And I think you have to use both a thematic approach and a very opportunistic approach to be very effective in terms of finding really awesome people and good ideas to make.
So how do you reach out to those people or get in touch with them? Are you messaging cold on LinkedIn?
I do it up. So I try to get warm intros when I can. I probably, from my Longridge days, like I love a good cold email. And I think that a good cold email goes so much further in terms of like laying the land and the groundwork for what that first conversation will be like. And it also means, especially for those companies and founders that are hard to break into, you have to put in the work. You actually have to have a good understanding of what they're doing for them to even think to open up the email when it's alongside 100 other people after they've raised an awesome round from top tier VCs and they're all over Crunchbase. So you have to do a lot to stand out. And I think the best way to do that is to actually have a good understanding of a business. And it makes for a better first conversation when you do that work too. So that is LinkedIn. That is me guessing people's emails or using tools that give me people's emails and doing that, as well as trying to get introductions from other people.
Hopefully chatting with Laura and I is a long-term ROI project.
It should be.
Moving into data privacy and attribution, you wrote a great piece called The Cookie Apocalypse on the BCV website. And I largely agree. There are a couple threats facing marketing and MarTech more broadly, and attribution and regulatory change with GDPR, as you mentioned, out of the EU, as well as kind of tech platform changes you see from iOS or Facebook updates. And then what I think is most interesting is change in consumer preferences data. And the most relevant example would be the adoption of a DuckDuckGo, right? Where people are choosing to use a different browser in order to not have their data tracked. And so I'm curious to hear your thoughts on these kind of three elements that are leading into the rapid change of the power of MarTech and attribution more broadly. What are your thoughts on how this could potentially play out over the next couple of years?
Things have evolved way faster than I thought, even since the iOS 14.5 update. It all started with consumers, as you mentioned, which is people want more privacy and they don't want people to have a hold of their data because they're scared of what's going to happen with it. What that's led to is the DuckDuckGos of the world that are enabling people to have more consumer privacy in terms of going about their day-to-day lives and how they scroll through the internet or peruse social media. There's two aspects to it, which is some people are not going to want to have any of their data shared. There's a whole nother set of people who think, wow, my data and everything I already do is already on the internet. And if someone really wanted to get access to it, they could. So why not just figure out a way to profit off of sharing my respective information back to a data intelligence platform of sorts that can create a knowledge graph with that stuff that I have, share it and sell it to big players that are trying to utilize it to make more informed decisions on how they do business, how they build products, how they do outbound marketing. I get a take of that. I get to have basically free flowing dollars into my bank account every month from just going about using my credit card or spending on Uber or Amazon or on Lyft. I'm a big Lyft user because of 3x points on Sapphire. So I hope other people do the same. I think that's like one area where we're starting to see companies then built on the B2B2C side, where you have a consumer application that enables you to do something that's fully private, or you have something that enables you to profit, for which you link certain accounts, and then you are able to help a platform sell that respective data to an enterprise. So that's one piece that I think is really interesting. The hard part about investing in those types of tools is you don't know the amount of consumer opt-in they're going to get. And I, for one, am not a very good direct-to-consumer or B2C investor, so I can't speak too much to how I think that's going to evolve. What I do see evolving is so much on the B2B side, which is, I think we've seen it especially with the people who are consumer-facing organizations. Those are financial services organizations, those are consumer brands, and a bunch of other things in between. Those people are realizing that getting access to net new customers has gotten incredibly hard. And what we've seen is customer acquisition costs going up so much to the point that people aren't able to run their businesses profitably and efficiently. What that actually means in practice is the idea of just like throwing $1 at Facebook and getting $3 in return of profit is those days are over. You can't just grow undeniably from throwing basically dollars into Facebook ads. At one point, that's why we saw such a proliferation of merchants on Shopify crush it, because they're like, well, I can just do this and it's always going to work. That just doesn't happen anymore. So people are trying to figure out ways to grow profitably, and it's twofold, which is I want to somehow have first-party data activation through surveys, through a bunch of other things. But I can also just use the anonymous data that I have now to actually make guesses and predictions, both in a probabilistic and deterministic way of what's going to happen with each marketing dollar or campaign and ad that I put out onto whatever that channel is. So what we saw originally was a huge push into people trying to re-architect attribution. And attribution is just a way of making educated guesses and weighting different stages of the consumer journey in terms of wherever they saw a respective ad or something, how much of that actually attributed to them purchasing. And that could be the billboard that you see, that could be the ad on Instagram, that could be, Will, I don't know, you saying something in this podcast about something that you really like, and then us making a decision on where I should pour more dollars into it because of what people are listening to. What people have realized, I think, over the last year or so is attribution, multi-touch attribution especially, has been a very effective way to help people recategorize how they're doing marketing work across any organization. And we've seen a ton of companies scale so fast. And as we mentioned, those are like market tailwinds. Whether or not those are durable are still a big open-ended question because of what's going to happen with third-party cookies from Google in the next 6 months. So other people have actually been thinking, maybe attribution isn't the gold standard for how I need to do this work. I should use media mix modeling, or I should do causal inference analysis to actually turn on levers and turn off certain levers.
And I want to give some light to your work done on the application layer, specifically understanding how AI will impact the amount of applications and the vertical specialization that you see from the application layer. What are some of the trends you're seeing within the application layer and what excites you?
There's still open-ended questions in terms of where we think value is going to accrue, both on the actual model layer itself, the foundation models. And for context, foundation models are exactly what OpenAI is building with GPT-4. It's using their own training and data set to deploy something that can be used for a multitude of different resources that people get access to, both publicly and privately, depending on the model. Then there's a middle layer, which is all these tools and wedges that are making it easier to deploy models, to use them more effectively, to use them at lower cost, to use only portions of them so you have a little more accuracy in terms of whatever use case you're solving for. Then you have the application layer. All are building really interesting categories and products right now. Obviously, the model layer has gotten a lot of attention, and there's been a lot of dollars flowing into it because of the cost of basically using a GPU to make that work. And as well as the middle layer, because there's been so many applications being built. It's like a tremendous amount. People need to have this middle layer architecture that makes it easier to abstract a lot of the hard work in the back end to deploy something with really good UI UX. So what that's meant in practice on the application side is a lot of really interesting use cases. I think the most formative one that people are familiar with is this company called Jasper. So they've just made the concept of marketing copy, which is me. Historically, I tried to spend a lot of time jiggering the types of words I wanted to put into a marketing message to get the highest amount of conversion and eyeballs on it. They've made that process so easy for so many different organizations, large and small, which is the reason they've scaled so quickly. But they're building on top of the big model. And what that means is it's pretty easy for other people to replicate the same type of task. And there's essentially a race to the bottom in terms of pricing or whether or not the models will build some of these types of tooling themselves. So I think what we look for on the application side are companies that have really unique data sets that they're able to utilize to fine-tune a pre-trained or an open source model or their own neural network architecture to produce a high-quality use case that has a bunch of downstream accuracy for just a bunch of small, unique things. I think the best example actually is we invested alongside Bessemer in this company called EvenUp. And EvenUp is a tool that automates the process of creating demand letters for personal injury lawyers. And the founder who actually started this company had a personal thing that happened in his life with family that is the reason why he went into the space to help solve this. And it's taking something where it's already really, really unique go-to-market or engineer building it, creating a super easy UI UX, where in some ways that is defensibility, and then building network effects on top of it, and then data network effects. The more you ingest, the better it gets. And I really like these vertical use cases that are actually getting so much more interesting than what vertical SaaS was a decade ago. And I think a lot of interesting companies will be built in these respective cases. We've seen the same in legal tech, a bunch of companies building there. We've seen a lot in marketing copy, whether or not it's defensible, and then a bunch in financial services too.
Is that where you're spending a lot of time, is in the vertical SaaS solutions?
Yeah, I'd say it's two areas, which is I'd like to find a lot of tools that are utilizing AI to improve productivity of their own margins, their customers' margins, as well as high quality output in terms of whether it's generative AI or just applied AI and things in between. I'm really spending time on the different modals. So you have, and what a modal means is text, image, you have video, you have code. And the video modal right now is one that's so hard to get right, but there's potentially huge, massive opportunities to utilize it super effectively and to be able to do things like run actual contextual and semantic search into a video, like command F-ing. Can you imagine just like being able to command F a full 3-hour movie? You knew everything of the last trilogy of Lord of the Rings, and you could just spend 2 seconds being able to say like X, Y, and Z in whatever I think happened without actually having to go through each single clip. Like there's just so much productivity that can happen across so many different use cases. And it's video for that. It's video for healthcare when you're doing surgery. It's video for police officers who are trying to do a better job tracking how they're performing and auditing their work. And it's video for trying to do a better job creating videos that actually drive marketing. I'm really just looking for smart people and smart people who have awesome wedges into understanding and focusing on being very customer centric and being able to build as much as they can so that they're deeply ingrained in an organization. It's hard to rip and replace.
And semantic search is a very interesting use case specifically. I know the Hebia team is doing a great job in financial services, but you mentioned Jasper, and quickly I want to touch on the impact that generative AI applications can have on marketing and marketing efficiency, because a lot of these applications help lower the barrier, the cost of creating new content. and makes it 5x, 10x easier and cheaper to create new content for marketing or distribution purposes. But obviously, with more content comes potentially a drop in the effectiveness of content that's produced. So I'm curious to hear your thoughts on the second and third order effects of lowering the cost of creating new content.
Actually, I fully agree with you, which is the more you create of something, the more it will inherently get diluted. So I think what it comes to is then the second order of priority, which is being able to build very effective ways to A/B test the type of content you've built is going to be effective or not. So I think what a lot of these tools have done such a good job of is something called like the prototyping phase, which is taking you from ground zero to one. You still have to do a lot of work in terms of being able to utilize whatever was created to make sure it actually converts effectively. And it's really, really strong quality. So now you have so much more data that enables you to build a data set, and you have your customer data and your historical data to match it against. That allows you to basically say, actually, this word versus this word makes a difference. If your chair was yellow, Will, instead of blue, then maybe 10 more people would join this podcast. It's small things like that that we actually can't even see on a very tangible basis, like just doing this, but there's a lot of like unique things that are happening just in the mind of the end consumer that people can actually input to help them make more informed decisions with the massive amounts of creative that's being done in the past 6 to 12 months. And I'm all for augmentation of any role. I think this idea of co-pilots are super interesting across so many different spaces, whether that's the co-pilot for marketing, the co-pilot for a therapist, the co-pilot for a lawyer, the co-pilot for the wealth manager you're working with. It's just helping them basically get a better sense of how to do their day job. But it's just a matter of utilizing that information and then surfacing it to the respective person in a very digestible way that they can actually take action. Because without taking action, there's no clear way to measure ROI.
So do you see some of these new generative AI marketing type platforms replacing some of the legacy solutions, such as a Nielsen?
The answer is there's always going to be something that comes along every decade or a couple of decades that replaces a legacy tool, just like the way the world works. And that's because of the people in the organizations, that because of the technical that they already have from building that type of product. The Nielsen case is a hard one. And the reason I say that is because as you get really big, you effectively have to become a managed service provider to do it all. And what the Nielsens and IRIs of the world do really well is they do everything for you, from insights to surveys to pushing out products, you name it. There are other legacy companies that will be disrupted for sure. And I think there are probably a handful or maybe more that do a really good job of moving with the trends.
So now for our last topic, let's just transition to the state of venture. It's been in quite the state of flux and uncertainty over the last year, whether it's venture funds struggling to raise or startups shutting down because of lack of funding. So I'm curious, just based on the current macro environment, your thoughts on the broader implications of how VC funding will continue to change over time. Are we still going to see these 10, 15, 20 times multiples on pre-revenue companies?
It's like a very tops-down approach to this, which is you look at the top 30% of high-growing public SaaS companies that are trading at a median somewhere between 7 and 8 times over revenue these days, or recurring revenue. We're starting to see a lot of that trickle down very slowly into the later stage growth and the growth of how we as venture and growth investors are valuing companies. I think we've inherently realized that so many of these companies just have a lot of time before they grow into those valuations. It's not that they won't. There's just a longer time period and a horizon in order to be able to make money for the respective people in your company to hit those respective strike prices. That's tough. People have been moving in that direction. But I think a big issue that, or maybe not an issue, is there's a platform shift that we just talked about to AI. And with the AI, people think that it is the next cloud compute. It is what .com was 20 years ago, is what the new networks like Facebook and social media were 10 years ago. People want to be on the forefront of investing in those respective companies and ideas or verticals. So what that means is if you really think these are going to be the next $10 billion, $20 billion companies, who cares if you get in at 50 or 100 or 200 or 500 post? Obviously, it makes it a little bit of a different sort of ownership, but you can still make a lot of upside. So what that means in practice is, yes, we are still seeing companies get incredibly high valuations with very little revenue thus far, but potentially sitting on something that gives them the opportunity to actually grow quite quickly once they figure out how to monetize. There's going to be a lot of bad vintages, obviously, for a lot of people. Like the 2021 vintage of your VC fund might not be as good as you expected it to be. Obviously, maybe you have a few that really carry the difference, but what you thought was going to be a 5x is probably more risk adjusted 2 or 3x, just based on where you invested and the amount of ownership you had. And the biggest difference we're seeing too is just the time horizon for that company to reach those respective goals. We all want to invest in a way where we are making money on the long haul, but also making money pretty fast to be able to reinvest that capital. And IRR matters. So if I can put an extra dollar into the stock market when it's yielding 8 to 10%, and it's going to cost me, like the cost of capital is like basically 20% in VC right now, who knows where to put the dollars? But you're really banking on those people, to sponsors of the VC firms, to do a good job of just investing in awesome people and being a part of those platform shifts, which is why we're seeing a lot of that still happen. But I think there'll probably be a little bit more of a shift towards more rational, whatever rational is, valuations that are more similar to what the median was over the past decade or 2 decades versus where they are right now. Just as because you think about like true terminal margin structure, when these companies get bought by private equity or go public, they need to have the underlying mechanics in order to get there. And you have to build a lot of those actual efficiencies and metrics and KPIs early into your business to help you actually achieve those goals in the future.
Yep. And to wrap up, we have 2 questions for you. The first one is, what motivates you to work hard?
The simple answer is this job is a big ball of anxiety. There's just so much to do at all times. And I am a person who is very task and data driven. So I want to just basically check off as many things as possible, but there's more the next day. So kind of being maniacal or very OCD about that is definitely what drives me to like be the best I can be, and look back in 20, 30 years and be like, I gave it my all in whatever that task was. The second is I've had the fortunate opportunity to be around so many smart people from the day I was growing up, and even so much more today, from talking to so many awesome founders, investors, and operators, and just seeing how passionate they are for their respective project and how hard they want to work to achieve that goal. I want to do the same for me, and it's very motivating to see them. So I'm motivated by people, and I'm motivated to do the same as I'm watching someone else do, or to do the same to be in a position to potentially help them in the future as well, and be as good as I can be on the investor side, or as a real thought partner or business partner, versus just someone on the sidelines who is not making a difference.
And then what's a piece of advice you'd give your younger self?
Probably patience is most important. My very serendipitous path to getting to the current job that I have is a very good indicator that you just have to put in the work and take the time, and things actually do play out the way you want them to if you just kind of go through a lot of emotions. It's okay to put your head down and learn. And I think that you can come up for air every few months, every quarter, every year, and kind of figure out, like, write down what you like and what you don't like about something. And then that helps you stay motivated for what's next. So the real technical skills I learned about what not to do when seeing a distressed company go into bankruptcy, in terms of like allocating what budget looks like and capital structures, and then how to be a little bit more very diligent and thought-provoking and do a lot of work to be a little bit more risk-adjusted and a little more of a value investor on the growth side at Longridge made a huge difference. And here I'm like basically doing something that's so different, but in many ways very similar, which is being able to assess risk, understand if we have risk-adjusted upside accordingly, and if we can get in at prices that are effective, but also being able to work with such amazing thought partners who can build transformational ideas. So I just try to bucket everything I've learned to always try to get to the next step. And what I realize is, like, yes, some people might really luck into an idea and it's awesome to do it so quickly. And then other people, like, it's okay to take the time to figure out what you really like. And then once you're super passionate about something, go run with it.
Well, Dawit, thanks so much for coming on the podcast and sharing your perspectives. Lauren, I appreciate the conversation.
Yeah. Well, Laura, thanks for having me. This is great.